When is the best time to invest in cryptocurrencies? DCA or dollar cost averaging strategies explained. When is the best time to invest in cryptocurrencies? You're a new crypto investor with capital you can afford to invest. You're keen to get started but don't know the best time to invest. Are you waiting for a 20% price drop? Do you wait a week to see if the market moves in any particular direction? What is the standard practice to minimize risk and maximize returns? I must first issue a disclaimer before answering this question. This is not financial advice, as I am not a financial consultant. This is my own opinion and not financial advice. Before investing in any of the various cryptocurrencies available, please do your research and due diligence. This video was created to help you easily understand the topic with our animated explanations. So let's dive right in. Data suggests that long-term investors are more likely to gain wealth than short-term traders, especially in the crypto world. While technical analysis of an asset acts as a compass and provides short-term guidance, it is never the holy grail. Over 90% of expert traders who only invest in shorter periods of up to 3 months before switching assets never recoup their losses and experience additional stress compared to even amateur investors who invest for at least 2 years. The crypto market is still evolving and is therefore not immune to global news that can potentially affect it in the short term. Cryptocurrencies such as Bitcoin can experience daily or even hourly price volatility. As with any type of investment, volatility can cause uncertainty, fear of missing out, or fear of participating. When prices fluctuate, how do you know when to buy? In an ideal world, it's simple: buy low, sell high. In reality, this is easier said than done, even for the experts. Instead of trying to short the market, many investors use a strategy called dollar cost averaging, or DCA, to reduce the impact of market volatility by investing a smaller amount in an asset like cryptocurrencies, stocks, and gold in a regular time frame. Dollar cost averaging may be the right choice when someone believes that their investments will appreciate or increase in value over the long term and experience price volatility over the long term. But in concrete terms, what is the dollar cost averaging? Dollar cost averaging is a long-term strategy where an investor regularly buys small amounts of assets over some time period, regardless of price. For example, investing $100 in Bitcoin each month for a year, instead of $1,200 at one time. Their DCA schedule can change over time, and depending on their goals, it can spread out over just a few months or over several years. The key is to choose a reasonable amount and invest regularly, regardless of the price of an asset. This helps to spread the cost of purchases over time and reduces the overall impact of a sudden price decline on a given purchase. If all prices do fall, investors using DCA can continue to buy as planned, with the potential for returns when prices rise again. Dollar cost averaging can help an investor enter a market safely, being to benefit from long-term price appreciation and average out the risk of short-term downward price movements. And in situations like the following, it can offer more predictable returns than investing a large sum at once. First, buy an asset that is likely to increase in value over time. If an investor believes that prices are about to fall but are likely to recover in the long run, he or she can use the DCA to invest cash during the period when he or she thinks a downward movement will occur. If he is right, he will profit by acquiring assets at a lower price. But even if he is wrong, he will have investments in the market as the price rises. Second, hedge bets through volatility. Dollar cost averaging exposes investors to prices over time. In the context of a market experiencing price volatility, the objective of this strategy is to migrate dramatic increases or decreases into the portfolio and profit a little from price movements in all directions. In the end, avoid FOMO syndrome, or fear of missing out, and trading based on emotional reactions. The DCA is a rule-based approach to investing. Often, beginners fall into the trap of emotional trading, where buying and selling decisions are determined by physical factors such as fear or enthusiasm. These factors can lead investors to managing their portfolios insufficiently think panic selling during a recession, or overbetting due to fear of missing out on exponential growth. Let me demonstrate a practical case. To determine this, let's look at an example using actual prices, as they were as they approached Bitcoin's biggest downturn to date. If you invested $100 in Bitcoin each week starting on December 18, 2017, near the price peak of that year, you would have invested a total of $16,300. But on January 25, 2021, your wallet would be worth around $65,000, a return on investment of over 299%. On the other hand, betting it all when prices are peaking is generally considered a bad idea, but how do you know? If you had taken the same $16,300 and invested it all on December 18, 2017, you would have lost nearly $8,000 in the first 2 years. Your portfolio would recover, but you would have lost the ability to generate your profits during that time, and you might have even sold your Bitcoins at a loss in a moment of panic. Let's say you waited a year and invested $200 in Bitcoin each month between December 18 and December 2020. In this case, your portfolio would total over $13,000 in 2020 compared to $23,000 by investing in the lump sum. This total bet investment would have given you a higher profit, but it would also have been riskier. Any significant price movement after the initial investment date would have affected your entire investment. Dollar cost averaging is about hedging your bets, limiting your upside potential to migrate potential losses. This is a potentially safer choice for investors as it reduces the risk of large losses to your portfolio caused by short-term price volatility. To determine if the dollar cost average is the right strategy for you, it is important to think about your unique investment situation. It is always best to consult a financial professional before implementing a new investment strategy. Do you understand the principle? With this DCA strategy, whether you are a beginner or an expert, you will win. Now let's move on to another strategy. It is especially for those who do not have enough money and will allow them to invest according to a well-defined logic. It is to determine the best time of the day, week, and month to invest. The best day of the week to buy cryptocurrency is Monday, when prices are lowest. Sunday is the second best day of the week overall. After that, prices rise, with Friday being the most expensive day to buy cryptocurrency. Because Bitcoin is popular with professionals, the market is most active during the work week. If you're looking to save money on your next Bitcoin purchase, consider buying it on Sunday or Monday before the market starts heating up. Prices tend to fall when the market is less active. This not only makes weekends the best days, but it probably explains why you should buy later in the day or night. In general, it is best to buy Bitcoins in the afternoon as prices tend to drop. On average, the best time to buy Bitcoin is between 3 and 4 p.m. If you are a night owl, you can also get a good deal between 11 p.m. and midnight. During these periods, the value of Bitcoin is the lowest, which means you don't have to shell out as much money. Whether you want to invest a little or a lot, you can save money by buying during these periods. If you're looking for the right time of the year to buy Bitcoin, wait for August. Bitcoin has a long history, and market tends to show that August tends to have the best prices for buying the cryptocurrency. Buying low and selling high can be a great strategy to making money with Bitcoin. If you want to treat it like a utility, this will give you the best chance of making a profit. And if you have tried any of the above or different methods, please share with us in the comments section. Making money with cryptocurrencies is great, but before you start investing, it's always important to be well informed. That's why we made another video especially for you. In this video, you will discover the 9 things you need to know before investing in cryptocurrencies. So we invite you to watch it by clicking on the thumbnail that will appear at the end of this video.